Welcome you all to the AAA pre-mock debrief for December 2024. This is Tashwita Gupta, your ACCA mentor. So guys, today we are going to see that what all do we have in this pre-mock debrief. So we will first see the question number one. That's what you do when you begin with your AAA exam. You are supposed to make sure that you do not scroll and check what is being asked in question 2 and 3, and you immediately start with question number 1. So the first question is worth 50 marks, with 40 marks being the technical marks and 10 marks being the professional marks. So now here, if you look at the partner's email, you will see the requirements are given to you. So you need to start the planning of the audit of Calibri company. So you are planning the audit. So that means you're in the planning stage of audit. The year end is 30 September 2015. So that means this is something important for us. And please, before you watch this debrief, make sure you have tried this question yourself as well. And if the time does not allow, then you don't have any choice. You can, of course, watch the debrief and solve the question along with me. So to help with this, I have provided you with relevant information. I met the finance director yesterday to discuss a number of matters, including some recent business developments. In line with the internal quality procedures of the Tahoma Associates, I have determined that profit before tax should be the basis of calculation of materiality. So my materiality is calculated on the basis of PBT, which is the threshold is 5% to 10%. Then, using the information provided, I require you to prepare the briefing notes for my own use. So first, evaluate the significant business risk is my requirement for 10 marks. So business risk is like each business risk is worth 2 marks. So approximately I would need 5 business risks. Then evaluate and prioritize the ROMM. And we are not supposed to do the inventory one here, because in the third requirement they have asked us justify why the inventories of part and pre-used cars have been identified as ROMM, and you have to give the audit procedure for the valuation of these inventories. So they've given you the assertion already, that use the assertion of valuation and give us the audit procedures on that. Then discuss the ethical and professional issues arising from the director's request and to provide the system and KPI sustainability reporting. Determine which of these services, if any, could be provided. So this whole answer is seemingly, you can say, not so strange to us, because this is like something that we all have done before as well. So what we will do is we'll simply copy and paste our requirements. That's the first thing that we do. So we just go to our word processor and we copy and paste the requirements. So first is evaluation of business risk. And then we have the ROMM for, the marks allocation is 12 marks. And then we have the inventory. Why is that ROMM? And the audit procedures or the valuation of inventory. Then we have the ethical and professional issues. And finally, we have to talk about the services which can be provided for 8 months. Okay. So these are the requirements that I have in place. Now, what do I do in a 50 marker question is first I prepare a format of briefing notes. So that's the first thing that we do. We prepare a format of briefing notes. That means to whom are you addressing the briefing notes? From whom are we, getting this? Then what is the subject of the briefing note? And then we talk about its introduction. So in introduction, we basically write about what all is included. So it's like a summary of requirements. I'm not going to write this out. So I hope we all know how to write it. It's a summary of requirements, which all are there within the briefing notes. And then finally, we start with our first requirement. So our first requirement is evaluation of business risk. So I need to read the whole question and answer this. So I need 5 business risks and I need to evaluate them 360 degree, right? And then I have to talk about ROMM, which is like first you talk about materiality, like you make a 3 marker, heading on that what is the materiality. So in this case, the materiality is based upon profit before tax. The threshold is 5 to 10%. Now, will I keep the threshold on the lower side or the higher side? So if the entity is high risk, then materiality is kept on lower side and vice versa. And vice versa. So you have to make sure that you are keeping it on the lower side if the materiality is, if the risk is high, materiality should be kept on the lower side. That's what we do in the ROM. Then after doing this, we will read the question and then we will, conclude whether it is a high risk company or not. Then we start with our ROMMs. So 3 marks for materiality, 9 marks are pending. So I need at least 3 ROMMs. So I will give 3 risk of material misstatements. Then what I have is I have that Y inventory is an ROMM. Now this one was worth a lot of marks. So if you look at the requirement, they've given this for 10 marks, but audit procedures are given within. So why the inventories of part and pre-used cars have been identified as significant risk of material misstatement. So this I can say this is worth 5 marks, and the procedures on the same are worth another 5 marks. So I will allocate 5 marks to the risk part and 5 marks to the procedure part, completing a whole 10 mark. Then ethical and professional issues are also there. That's what we deal towards the end. Okay. Now let's start with reading our question. So first we read the company information. So we are supposed to find ROMMs and we are supposed to find. Now, if you look at the question, they've given that for ROMM, you have to use exhibit 2 and 3. So we're starting with exhibit 2 now. So let's find ROMM and business risk from the exhibit. Now, Calibra company is a family business which was incorporated 30 years ago. So that means it's a small company, it's a small business. Now, Calibra operates under a franchisee agreement with a single manufacturer. So you just have a franchisee arrangement where a manufacturer has actually given you his franchisee, which is Perpetua Car Company in 8 locations. All these locations are in the same country as the manufacturer, so there are no foreign currency transactions. So this is one of my business risk, isn't it? That I operate under one franchisee arrangement only. So single franchisee arrangement. So why is this a risk? I'm writing in short form, you'll write in small paragraphs. See, if there's a single franchisee arrangement, what if the contract of franchising is withdrawn? So what about your business model there? So it's like you just have one manufacturer, that is Perpetua Car Company, and you just have 8 locations within the same country. So what if one of your franchisees are taken away, or all your franchisees are taken away? What if your relations with Perpetua Company are distressed, due to which you might have to let go the franchise? Now that really challenges your going concern, because then how will you carry forward your what will be your nature of business, like how will you continue your nature of business? So that is a challenge to the going concern, which is why this is a business risk. That's the first business risk that I have identified. Then what I have is car sales. We have 2 business divisions. Car sales are made up from showrooms as part of a dealership franchisee package with Perpetua cars. Calibri is permitted to sell new Perpetua car vehicles to the manufacturer in that specific territory. The arrangement requires single upfront fee of 8 lakh for each showroom location. So it's like you are paying some money to get that franchisee from Perpetua car. So you are paying for 8 lakh for each showroom location. This gives Calibra the right to sell vehicles manufactured by Perpetua and make repairs to pre-used cars using manufacturer approved parts. This fee is non-refundable for each new showroom. So it's like for every showroom that you open up under this franchisee, you have to pay 8 lakh. Now, franchisee agreement lasts 10 years. So it's like the life of this franchisee arrangement is 10 years and can be withdrawn without refund if franchisee conditions are not met. So like, it can be withdrawn. So that's what we can use as our point in the first business risk. So, this can be withdrawn. This is something that we should be aware of, that if conditions attached to franchisee arrangement are not met, then the arrangement can be withdrawn. And if it is withdrawn, then of course this will impact our going concern. Okay. So then what we have is this includes the requirements to update fixtures and fittings as required by Perpetua to ensure a consistent brand image. So it's like you have to make your interior of the showroom same as Perpetua cars and to meet customer service and sale volume key performance indicators. Providing these requirements are met, it is customary for franchisee arrangements to be renewed automatically after the initial 10-year period. So historically, Calibra has always had franchisee agreements renewed. As such, have determined it is appropriate to capitalize the upfront fees as assume the life of the asset as indefinite life. So they are saying that you are keeping the life of the asset as indefinite life because you're thinking that everything will be good and there will be no breach of conditions. So that is something which is an over optimistic assumption that we have made. So this is not just business risk, but this is also an intangible asset. It's an ROMM, intangible asset franchisee arrangement. So here you will first mention about what is the materiality of this. So if you talk about franchisee rights here, I would say that this is an intangible asset. And how many franchisee sites do we have? If you just check that out, okay, fine. So they're saying that Perpetua owns car showrooms which are then leased by Calibri for the fixed duration of 10 years. If the franchisee is withdrawn by the manufacturer, okay, then we have customers part exchange. Okay, so how many, franchisee arrangements do we have for how many showrooms do we have it? If you read that part, okay. See, Perpetua has provided Calibra with notification of their intention to withdraw franchisee rights in one of their locations. So in one of the location, the franchisee rights are even withdrawn. So that is something that adds to our business risk. And this is also an indicator of impairment. Now, Calibri obtained the franchisee right on location on 1st October and has failed to meet sales targets, resulting in the revocation of the agreement. Franchisee fees non-refundable. In addition, 3,50,000 will be required to terminate the lease on the property. So it's like there are some franchisees which are being lost in this situation. Why? Because their conditions attached to the franchisee were not met. And that is why we lost the franchisee. So we can simply say that first we will say that $8 lakh that is being paid is capitalized for each franchisee showroom, and it is capitalized as an intangible asset as per IAS 38. And now whether it is a definite or indefinite life asset is something which is subject to judgment, management's judgment, and not just judgment, it is subject to management judgment. So it is also subject to management bias, right? And then if we consider this as indefinite life asset, it has to be, annual impairment review is to be conducted on this, which doesn't seem to have been conducted, where we have to impair the asset by taking it to its lower of cost, or can say carrying amount, and recoverable amount. Then you can tell them what exactly recoverable amount is. Recoverable amount is higher of fair value, less cost to sell. So we have to make sure that we are impairing it. And yeah, so if we have not done this, the risk is that the assets are overstated and profits are also overstated. So assets and profit are overstated. So that's the risk that we might have. Now we will say that because there was, there was something which is known as withdrawal of franchisee rights in one of the locations. So we'll say this is something which will lead to being an indicator of impairment. And each showroom that we have is basically a CGU. And if a CGU is impaired, what is the way you allocate the impairment? The rules of impairment are same, but first you allocate it to damaged asset, then you allocate it to goodwill, and then to other assets on pro rata basis. So that's what you do, right? And the risk is that this is not being done, right? So improper allocation of or total missing out on the impairment of CGU is the risk. So see, this is what I've written for around 4 marks. This is intangible asset franchisee right. Now, guys, if you just read the question ahead, they've given you some information that how the franchisee, there are conditions attached and everything. So this is something which will lead to even your, you know, this is something that you can even mention in IS 38 that these costs that we bear, the cost of fixture and fittings, the cost of, consistent brand image, these can also be capitalized. Then we are talking about Perpetua Car Company owns the car showrooms, which are then leased by Calibra for the fixed duration of 10 years. So what about these leased things? If the franchisee is withdrawn by the manufacturer, we will have to pay a penalty fee to exit the property lease early. So there was a, withdrawal. So now that means I will have to pay some penalty. So this will also amount to some provision. So I can talk about IS 37 here that penalty fees that we pay, the penalty fee was 3,50,000, and the loss of non-refundable deposit that we made of 8 lakh was there. So you can just cumulatively say whether it is material or not. Most probably it will be material. And we will have to create a provision on this. So we will explain first of all what is the provision. Provision is made up on, whenever there's a present obligation due to past events, which will lead to future outflow of resources, right? So this is something that we do in provisions, and we have to create provisions if it is probable that this will happen. Now, in this case, it seems that it is probable that we'll have to pay this money, right? So this is probable that we'll have to pay this money. So a provision should be created. And the risk is that we've not done this, which will lead to understatement of liability and overstatement of assets. Sorry, profit. Right? So this is the risk here regarding IS 37. Then if I move ahead, what do I have? Calibra customer can part exchange their old car and receive an allowance against the cost of a new car. These part exchange cars are then serviced and sold as pre-used vehicles. Then this is all related to inventory. Like if you have cars, you're selling cars, so car is your inventory. Then Canberra company operates a car service and repair facility at each of its showroom. Repairs are carried out in a motor vehicle workshop and large amounts of car parts are held in inventory to enable repairs to be made on a timely manner. Customers have a choice to pay the manufacturer approved parts or opt for cheaper generic vehicle parts. So what are you doing? Cadbury operates a car service and repair facility in each of its showroom, where you have, motor vehicle workshop and large amounts of car parts are held in inventory. So it's like you have a lot of car parts in your inventory. The risk is that they might have become obsolete because you make them available in timely manner. So it's like you've stored those parts, so they might become obsolete. Then customers have the choice to pay for the manufacturer approved car parts or opt for cheaper generic vehicles. Okay. Then what I have next is, if I read the third exhibit, okay. They've given us projected financial results. So they've given us projected results in terms of revenue and PPT. New car sales represent 70% of Cadbury company's projected revenue. So, 70% of your revenue is dependent on new car sales. At present, Perpetua cars do not have any ranges of electric cars. However, they are planning on to release first electric car in 2018. So this is a business risk that you have. So you are selling new cars and that is 70% of your total revenue. So how does that make a business risk for you? So you can mention it here that, okay, right. So the first business risk we've already mentioned is single franchisee arrangement. Now, the second business risk which I have in mind is, okay, that we've lost franchisee rights. So loss of franchisee rights. So it's like when you lose the rights because of not meeting the conditions, you can specify that there were conditions like you have to meet some KPIs and you have to meet some fixture and fitting requirements. If those are not met, we will lose the franchisee rights. That's what has happened. And if that happens, this affects the sales and this affects therefore the going concern of our company, right? So we are affecting a going concern because of loss of franchising rights. Then if we talk about that new cars that we have, so there is a market reliance on sale of new cars. Now, how is that a business risk? So you will say that, people will buy new cars if they have purchasing capacity. So people will buy new cars if there is purchasing capacity. Now, if that purchasing capacity is not there, maybe due to some recession, so that will affect your market. So that is like we over rely on these sales. 70% of our sales are dependent on the sale of new cars and not just repairs, right? And also the fact that, the cost of fuel these days is increasing. So people will try to buy some, good fuel-free cars, which are like based on electric vehicles and all. So if you don't do that, you will, ultimately you will lose to the competition. So lose to the competition. That is something that you can mention. And then you will talk about the fourth thing that we have second-hand car and parts in the inventory that we have. So, the inventory parts that we have actually increased in the years. So if you just look at the meeting notes, you will see here that our fixture and fittings used cars are 200, parts are 80. So that means, our used cars have actually increased. Okay, so it's like we have a lot of inventory which is still there in the warehouse. So you can just see here that okay, other assets are held. Finance director of Calibri company has stated that these assets will be utilized at other sites. No adjustments have been made. Okay, fine. So this is something which is a risk. So we can say that our obsolete inventory is also a risk that we have. In the business risk part also, you can mention it. So we can say that, we have large number of second-hand cars and spare parts in our inventory, and they are just increasing every year. So this will increase our cost of storing the inventory, or you can say cost of holding the inventory will increase, and this will ultimately increase your operating cost, and that would ultimately affect or reduce your profit, which will lead to like going concern problem, or you will have to deal with a lot of competition, so your cost will be high in this competitive market, which will again impact your going concern somehow, right? And then we can even mention about electric vehicles. So if you see, they have mentioned it clearly over here that we do not make any electric vehicles. At present, Perpetua cars do not have range of electric cars. However, they're planning to release their first electric cars after 3 years. So there's still 3 years, whereas our competitors might be having it. So we can say that people these days are becoming environment friendly. And because we are becoming environment friendly, so we all want to reduce the pollution. We need reduction in pollution. And therefore, if we want to reduce the pollution, then of course, we need to move towards electric cars, which is basically our, way to reduce pollution, which is fuel free, safe to the environment. Competitors have these, and we still don't have it. Still don't have it. Therefore, it's a business risk. That means we are not, there is a disruption in market and we are not able to change as per the disruption. So this will again affect your going concern and your profitability in future. So these are the 5 business risks that I have identified so far. Okay, then reading ahead what we have in the meeting notes. Other assets, okay. The finance director has stated, okay, we've already looked into that. Potential future listing. So Calgary company has decided to obtain a stock exchange listing and is hoping for initial offering of shares during 6 months. So now that is a business risk and also a ROMM, because if you are looking for listing, that might hamper your judgment. That means you will become biased, because for listing you need some kind of results to be met, and for that you might overstate the results. So with this in mind, the board of directors are keen to ensure the financial statements to 30 September 2015 show a strong performance for the year. So there is a pressure, right? So we have a pressure to show good results. So pressure to show good results. Why? Because we are seeking listing. I would say this is the high priority risk. This will increase management bias, which is also reflected in like areas where we have to make assumptions, like life of the asset, like for example, whether the impairment has been conducted or not. So all these things, like we are supposed to link it with management bias, right? Plus, we might actually try to overstate profits and assets. That might be our actual intention after the fact that we are supposed to seek listing. Now, if I talk about business risk, then this potential listing is also a risk. Potential listing is a risk. Why? Because once you get listed, there is a lot of compliance that you have to, and this increases your compliance cost, which impacts profit. And the fact is that if you're not able to comply properly, there are some legal consequences that you might face as a company, which will increase your cost as well. So there is a compliance risk all in all, and I would say this is a high priority risk. So make sure you keep it on the first go in the business risk. Then what do I have is audit committee and internal audit. Now, in order to improve the company controls prior to listing, Canterbury Company recruited a newly qualified accountant with experience in external audit. So basically, for internal audit, you have kept a newly qualified accountant. Okay, so that is something which is not a good quality thing, because if I talk about listed companies, they're supposed to follow certain corporate governance rules, that means best practices, where they're supposed to keep or have an internal audit department with prerequisite knowledge. Now here I've kept a newly qualified accountant who has no experience, right? So the company aims to create an internal audit department and hopes by 31st December, we will have 2 full-time staff in that. In addition, Calibri has appointed the 2 independent NEDs from the car industry and intends to have them recruited by the 31st December. So they may create an audit committee that is independent. Neither of the entities are appointed have financial experience. So this is a poor corporate governance, which can be mentioned. So in the ROMM part, you can say that due to this poor corporate governance, there is a control risk. That means there will be weaker controls. And here in the business risk, you can mention this point as poor corporate governance. So what we can mention in business risk is basically that we did not have until now, there were no NEDs, but we are seeking listing. So we've recently kept two NEDs, but none of them have financial experience. Okay. And even if I talk about internal audit department, as per corporate governance best practices, we should have a good internal audit department. Now, since we do not have a good internal audit department and NADs, the NADs number is inadequate, and the human resource, you can say, capability is inadequate because you've kept someone as NAD who does not have financial experience, and you've kept a newly qualified accountant as your internal auditor. So that is leading to inadequate, you can say, knowledge which is coming in, which will lead to and poor leadership and lack of expertise in the board, which can, give you a lot of weaknesses in the company in terms of controls. So again, this is a issue which is going to make it a company less profitable, because more intelligent people you have on the leadership roles, board level, better it is. So if you do not have good amount or good people, then that is going to impact your profitability. Same you can write about poor corporate governance here a little and just tell that how controls are affected because of it. If internal audit won't be there, then the first layer of misstatements won't be removed, and the controls will be deficient in a way because we don't have good allocation of human resources, right? So these are the points that we can mention using the two working notes that we have just read. So this is enough for the business risk 10 marks, and for the the ROMM 12 marks. So 4 points for ROMM plus materiality. So if I talk about materiality, I can say that here we are seeking listing, plus we have, there is a risk of management bias here. So it's a high risk company. So my materiality is kept at oversight. So you can calculate the materiality as 5% of PBT. That will become your materiality threshold. That's it. So this is what you were supposed to do in your first few parts of the question, where you mentioned about business risk and the ROM. Then they've asked you why inventories of parts and pre-used cars have been identified as significant risk of material misstatements. Let us try and solve that one. So here we are supposed to use the exhibit number 4 and then justify that why inventories of parts and pre-used cars have been identified as significant ROMM. So let us look at the exhibit number 4. So full inventory counts are performed once a year in March, and the year-end figure is obtained via a roll forward of transactions. So it's like you do not count your inventory throughout the year. It's just that you count it once every year, and you do a roll forward of transactions from the date of inventory count to the year end. So that is something like, there's a control risk here. Roll forward means that you are just going to not count the inventory and just roll forward the transaction, just bring them ahead to the date of your new inventory count. So that is something which we can mention is significant ROMM. So we can just talk about that how the roll forward of inventory So we can just mention about inventory count, and we will say that we do not do like continuous counts on inventory is not done. Rather, it's just done once every year with a roll forward of transactions. Now that means that there might be some, you know, there might be some control risk over this because you're roll forwarding the transactions. So there's a control risk which can be there, and the risk is that your inventories might be incomplete or overstated. So basically misstated, right? Then let's read the second thing which is given to us. What is our inventory count? Last year it was 480 for parts and it is 580. So this has increased. So first of all, the risk is that your inventory has become obsolete. Then used cars, it has also increased. So that means there is also risk of obsolete inventory here. So the latest inventory count was attended by the audit team, and the systems for monitoring the inventory levels and count procedures were assessed as adequate after controls testing and spot counts were performed. However, the audit supervisor highlighted the following concerns. It was noted that during the count, the inventory is marked with a colored sticker to show that it has been counted. So when you're counting your spare parts, you are, marking them with a sticker that I've already counted it. The color of the sticker is changed each year to avoid confusion with prior counts. Now it was noted that during the count that some of the parts held were marked with as many as 5 different colored stickers. So it's like they are still there since 5 years. So that is a clear indicator of obsolete or slow moving inventory, which might have amounted to loss. But since we want to overstate our figures as we are biased in this situation, so this might this might reflect that our inventories are overstated. Now, it was noted that during the count that inventory levels of used cars had increased significantly despite there being no increase in sales volume. So again, that is something which is an indicator of obsolete inventory. So the valuation of used car inventory was not performed during the count. However, the audit supervisor did note that some of the cars held at the location did not appear to be a saleable condition. Again, obsolete inventory due to damage whilst the held at the car showroom site. So our second, first was roll forward, the reason why inventory is in ROMM. Second is that we would mention about the valuation of inventory. So in this, you can talk about that inventory should be valued at lower of cost and NRV. Then you can explain about certain things which suggest obsolete inventory. So you can talk about the things like the parts and used cars have increased. So you can mention the percentage, like, how much percentage increase is there. So parts have increased from 480 to 580. You can calculate the percentage of increase. Same for used cars. And then you can mention that for the parts, there are certain parts which have 5 color stickers. So basically, they are being used for 5 years, and that is again a suggestion of obsolete inventory. Same, you can mention about used cars that there are some damaged cars which are not even in right condition. So they are to be, there is a loss on inventory, and the risk is we have not accounted for that loss. And then you can even say that this is when we talk about NRV, NRV is like fair value less cost to sell, which somehow involves use of judgment. And since in this case we have a lot of biasedness involved because we are getting a possible listing, so the risk is that we have made overestimations. So there is an overestimation. So our reality is different from our estimates, and that might have led to increase, or we can say overstated profits and inventories. So that's why inventory is a risk of material mistake. So this one was worth 5 marks, and I've given you so many points that you can reflect upon to get your 5 marks. Now, similarly, you will write your procedures that should be performed on your inventory. So you can give 5 procedures, okay? So I'm just giving you a short form of it. So for example, if I talk about NRV, So for that, I can inquire from the management to assess the reasonableness of their assumptions, to value the NRV of inventory. Then we can talk about the slow moving inventory. So what we can do is we can obtain the inventory ledger or sheets to ensure correct treatment of obsolete inventory, right? Then similarly, you can mention more things about the valuation of inventory. So we can talk about analytical procedures that can be performed. So you can perform analytical review of used car inventory, where you can compare the volumes of average car value, the historical cost of the market data. So you can perform the valuation on historical cost versus market value and check for variations, right? Then you can use, you can do sensitivity analysis. So you can do sensitivity analysis that how market conditions changes and how does that impact the fair value of the cars. And then we can talk about various other costs and valuation. So we can discuss, or we can even obtain a written representation from the management for their assumptions, right? So these are the points that you can mention. I've written in short form as ordered procedures. So that is something which was there in question number 1. And then if you read your 5th working note, they have given you something that you have to use for discussion of ethical and professional issues. And plus you have to tell them whether which of these services, if any, could be provided. So what are the ethical and professional issues here? So category is to include additional information within this year's annual report to demonstrate sustainability targets and achievements of the company. So this is something that we are going to do. That means it is a sustainable report that we are going to prepare this time. In our annual report, your firm has been approached by the directors to determine the appropriate sustainability KPIs. I would say if you decide what are the KPIs, then you are assuming management's responsibility. So this is a management threat, so you can't do it because no safeguard can reduce your management threat. So first ethical issue that I have identified here is that, that management threat exists because you can't decide something. So deciding the KPIs is the role of management and I can't take over that. So this is something that we will say is a management threat and no safeguard can help to reduce this management threat. So no safeguard can reduce the threat. Then, okay, what we have next is second point. Let's see. Then Calibri also requires assistance from the HOMA to establish the systems to capture and measure sustainability information. So now this is a system that you're establishing. So this is something which is again that you're developing systems, but these systems are not related to financial statements. So this will lead to self-review threat because you will make the systems and you will be checking the controls over that as well. So this is you'll be checking your own work. But since the company is unlisted, you can still provide it with safeguards. Like you can have separate teams who will work on these 2 assignments. Then directors require a separate assurance report on these KPIs, which they've asked the HOMA to provide. So this is like you are giving a separate assurance report on these KPIs. So this is nothing but sustainable, reporting audit. This is as per ISSA 5000, that is the exposure draft, which we talked about in the grand revision. So the directors required a separate assurance report on this, which is something that you have to. So this is something that we will just simply say that yes, this is something we can provide. If it is not against our, this will also again give rise to self-review threat because if we are, reviewing or making the KPIs, and then you're also reviewing the financial statements. So that might create a self-review thread. And then you will just explain this stuff in like giving the safeguards and all and why the threat is there. You can even mention that the significance of these threats is low because this is an unlisted company. And since it is unlisted and a small business, it can move forward. But the fact that we are trying to get possible listing, that increases the significance of the threat. Then the requirement also asks you that which of these services can you actually provide. So here they have written that determine which of these services you can provide. So we'll say we can't provide the first one because that is management threat. The second we can. So we can just talk about that, it's an unlisted company, but anything which creates management threat is prohibited. And then we can give other services with safeguards, and that's it. So you can provide the second last two services, but not the first one. So this is what your question number one had, and I found this question very easy because this is something which is predictable. I told you the new type of questions, examiners' favorite questions, where they give you that why inventories in ROMM, and the mark allocation made it easier because you were not supposed to write too many points. So that's why I believe that this question was very easy for your AAA paper, provided you have the technique to write your answers. Okay, now let's move on to question number 2 for this paper and see what's being asked there. Okay, so in this question, they've given us certain requirements where they have asked you to comment upon the quality of the audit. That is the best kind of requirement which is there in question number 2. So here they've said discuss how requirements of ISQM1. We've discussed ISQM1 in our grand revision, the 8 elements of ISQM1. You discuss how the requirements of ISQM1 should improve the audit quality and help to restore public trust in audit profession. Your answer should focus on the following principle. So this is a direct question for 6 marks where you should tell that how you should accept and continue the audit for your clients, like doing their KYC, checking their integrity, checking their reputation, keeping that as an ongoing process. Then communication and use of information technology. So these are the 2 elements of out of the 8 elements of ISQM1. So for direct 6 marks, they've asked you this question. So I'm not going to explain you. Check that out. I hope you all have covered it. Then evaluate the quality of planning and performance of the group audit in discussing the quality management and other professional issues in your file review. So basically, they're saying that tell us whether the quality of the audit was good or not. Evaluate the quality of audit. So again, you have to see what were the drawbacks and then describe quality management processes Adana and company should have in place to would have prevented these issues. So this is a 14-mark question just related to quality management. So here we have to tell what is the good quality audit, what is happening, and what is the bad quality which is happening, and what all processes should have been there. Oh, let's begin with this. So let us check the exhibit. First exhibit is regarding consolidation. So it is 1st July, you are an audit manager in Adana and Company, which is a firm of chartered certified accountants, and you're responsible for performing the post-issuance engagement quality reviews. So let's read the consolidation part. Kochi Group, which is a group whose financial year end is 31st January, and the audit report includes unmodified opinions. So here we've given an unmodified opinion, so that means we have not found any misstatement. And the statements recognize profit of this much and total assets of this much. This is just given to calculate materiality. Then you have identified the following 2 issues. Let's see what are the 2 issues. I'll just annotate through the screen so that we just complete this ASAP, as this question is more of brainstorming. So Adana and Company has an audit department in Farland, which it uses to perform routine and low risk testing in order to reduce cost and increase efficiency. So now this is something that you've used, out of the country offices for your routine low test working just to reduce the cost. So this is a bad quality thing. Why? Because now you will explain in detail that these routine or low risk testing is something which, if you've done this for efficiency, fine, but if you've done this for reducing the cost, then it is not a good quality audit. And it's really important that the auditor must be available on the field. And because the audit is a very technical thing to do, so we should be present on field. There are a lot of things which are supposed to be checked by hand manually. So the group audit working papers document that the funded department was used to carry out the work of agreeing the figures included in the consolidation to the underlying audited financial statement for each individual company in the group. So basically, they used to check what they've written in the group company, like group accounts, versus what is there in individual accounts. They were just agreeing these, figures. So that is a very less work. This is a less substantive work. So we are supposed to do a full length substantive work on consolidation because acquisition is a very material event, especially if the subsidiary is a component which is material to you, a significant component. So this was in accordance with the audit plan, which was approved by the group engagement partner. Now, no further work was performed on consolidated figures, which includes goodwill. So you have not done any work on goodwill. That is a bad quality audit in itself. So you'll say goodwill is a very technical thing where we have to fair value the assets of the subsidiary, and that is involving a lot of judgment, and it's a very complex area which is inherently risky. And then you say you've not performed any work on it. That's very bad. So the value of goodwill is also given 6 million, so you can calculate its materiality. And there was no work done on elimination of intra-group balances. So again, you can explain that what is the treatment of intra-group balances and how they are very complex in nature because its identification is very difficult. So we'll say the identification of intra-group balance is a challenge because you never know what is happening between parent and the subsidiary. The audit supervisor has reviewed the consolidation adjustments with a note stating that these had been confirmed by the Farland department and no further work was required. Okay, so the audit supervisor has reviewed the consolidated adjustment that this was confirmed by the Farland department. So that means the Farland, we are relying too much on the work of Farland department, and we are not even seeing that they are located in some other country. They have no on-field access to the resources and the documentation, and maybe they're not, well equipped or have the prerequisite knowledge, training, and experience. Right. Upon review, you note that intra-group balances have not been reconciled properly, and the receivables balance totals 1.2 million more than the payables balance. So this is something which is a material misstatement, which Farland has been not able to figure out. So this means your audit planning has failed. Right. So this is what you will say, that this suggests that this was all because you wanted to reduce costs, so you've done all these things, which has resulted into a bad quality audit for the coachee. So these are the points that you will reflect upon. I hope you all have brainstormed on that. Let's see what's the next exhibit, Miri Company. So here in the Miri Company, let's see what's given to us. Okay. So Miri Company is below the audit threshold in the jurisdiction in which group is based and does not require an external audit to be performed on its individual financial statements. So in prior year audits, Adana has limited the work on Miri to detailed analytical procedures only. And this work was often completed by an audit assistant due to immaterial nature of amounts involved. So there is a subsidiary, and on that an audit assistant is working. So we are supposed to, as per the ISA, we should check the work of component auditors also. And especially, this is something which is done by the assistant. So assistant is a very small person in his knowledge, training, and experience, which is not a good thing. Then, however, in December, Miri acquired the trade and assets of a competitor, and as a result, company had assets of 4.1 million, and significant addition to the assets also provided the group with access to a new aspect of the industry, providing private charter flights for business clients, a market which group previously had no presence. Then this is a material event. So when this acquisition happened, this is a material event which you have failed to recognize. and still your audit assistant is doing work on it. Then the group audit plan indicates that the plan procedures for Miri were not updated from the previous year. The only reference to the acquisition is within the working papers. The review of the group board minute, which states as the acquisition occurred close to the year end, the impact on the statement of profit and loss is not material. As such, no further work will be needed for 31st January. So we will say that, see, we need a proper work that, or we need proper, sufficient and appropriate audit evidence for this acquisition. And, this transaction has resulted in a lot of judgments which must have been made, like you must have, calculated depreciation for the new assets. And we should have more people of senior level working on this. And this is something which suggests that quality of audit was not good. And you just, said that the only reference for the acquisition is within the working paper. So acquisition happens completely. It's not that you just mention it in the working papers. And the working papers related to Miri are initially being reviewed by the audit supervisor only. So it's like all the people should be, there will be a proper supervision where the supervision happens in each stage of audit. So it's done by the audit junior, then reviewed by the supervisor, and then reviewed by the senior manager, and then by the engagement partner, whatever the hierarchy is. And if you have not done all these things, that means there's a lack of supervision. So these are the points which you will mention, and I highly recommend that you read the answer of this question, so that I would say this is a very easy question itself. Like if I compare it to question number one, it's easier relatively, and it's more about that what's going right and what's going wrong, and explaining why the things are right or why the things are wrong. Right? So this is what we would mention in the first quality problems. Then what are the procedures that we should have in place to ensure that our quality of audit is maintained? So what procedures should we put in place? Uh, we can just simply mention that we keep, total check on who is, like, we should have a proper supervision, first of all. We should emphasize on that. And then we should have a good allocation of human resources. So we should not rely on juniors for the work to be done on material things. Then we should, amend our audit approach and make firm policies. Like this is what we have to follow. We have to make stringent rules that there will be a planning meeting and the work will be allocated and how the audit process will work, right? And we should we have a firm-wide update regarding how the review of work is done. So review should be very strict. So this is something which we can do. And then we can go and train our audit team members to maintain the quality of our. So these are the things that we can mention as our. That ends our question number 2. And I think this was a very easy question. Again, just basic for the question management. Next comes question number 3. And if we just check out their requirement, what they ask you here is explains the matter which are to be considered in relation to perpetual inventory system on completion of the audit and which should be communicated to TCWG. This is to be commented after reading Exhibit 1. Then comment on the matters to be considered and explain the audit evidence you would expect to find during the review of audit working papers. So how do you answer your comment on matters to be considered? So first requirement and second requirement, it's matters to be considered. So here you mention your MTI, you talk about the materiality, you talk about its treatment, and then you talk about how does it impact your financial statements. So you talk about MTI, and then you have to give evidence along with it. You have to give evidences along with it. That's for 8 marks. And then completion update. So now evaluate the appropriateness of draft auditor's report, assuming that no further adjustments will be made to the financial statement. So this is another example of critical appraisal of the audit report. So this is basically, it's now 1st August, and following your review of the audit working papers and your initial discussions with the client, the finance director of Sunny has agreed to include a disclosure note, and they will make a disclosure note for uncertainties about export restrictions in Farland. potential going concern issues. Management confident company will survive these current difficulties. The draft audit reports include an unmodified audit opinion and a key audit matter referring to the disclosure note in connection with the going concern status. So we will say there is a material uncertainty regarding going concern in this case. Most probably, this whole thing reflects material uncertainty regarding going concern. So rather than making a MURGC paragraph, they're putting it in CAP, which is incorrect. So you will mention about it. You can tell what goes into MURGC, what goes into CAP, and how they have misplaced the thing which should be treated as MURGC as a part of CAP. That's it. Now let's try the first two parts of this. Let's start reading our question. So we will first read exhibit number 1 and explain the matters to be considered in relation to perpetual inventory system on the completion of audit, which should be communicated to TCWG. So again, this is to be replied in terms of MPI, which is materiality, treatment, and impact. Okay, so the audit of Olive Company is a listed company for the year ended 31st March, and it is nearing completion. An auditor report is due to be signed next week. Now, final materiality for this engagement is set at 2,50,000. So that materiality threshold is already given. Now, Olive Company operates a perpetual inventory system whereby a number of inventory lines are counted at the end of every month. So unlike our first question that we did which had a roll forward of transactions, we are counting our inventory perpetually. Every month end we are counting it. So by the end of reporting period, all of the lines have been counted once. So it's like you are perpetually preparing. So every month you are preparing your syllabus. So by the end the quarter ends, you have done it completely. Everything has been done once. It's not that you're preparing towards the end. So at the planning stage, the audit engagement partner made the decision to adopt a control-based approach to inventory. Therefore, the audit team attended the inventory count at the end of February and reviewed the level of discrepancies found for each 12 months monthly count prior performed over the year. So what they've done is they said the audit team attended the inventory count at the end of February and reviewed the level of discrepancies for each 12-month counts performed every year. At the inventory count in February, the audit team identified the following. There was no segregation of the goods received and dispatched during the count. A difference of 53,500 was identified. So you will say whether is it material or not. So this is not so material. So between physical and the inventory records. On review of other monthly discrepancy reports, similar differences were noted at each counts. The discrepancies were reported each month to the finance director, but the audit team was not able to identify any other further action that was taken by audit. So basically, in perpetual counts, there were no segregation of good received and good dispatched. That's a control deficiency, which we reported to TCWG, but they did not take any action on that. Secondly, every month there were some discrepancies which were being recorded, and again, TCWG has not taken any action on that. So the audit supervisor documented a conversation with the finance director at the inventory count concerning the discrepancies and the possibility of conducting a full inventory count for reporting purposes. The finance director assured that the audit supervisor that there was no need to conduct a full inventory count at the reporting date, that the financial year end inventory provision is more than enough to cover the differences identified. So it's like we wanted to count the full inventory, but they said no, there's no need to do it. So they're limiting the scope of our audit. They're directing us what to do as auditors, which is not acceptable. So full inventory count was not conducted and the discrepancy report count recorded no reduction in the differences between the records of physical count inventory. So there are very many issues related to these inventory counts. So what we are supposed to mention in our first requirement is regarding Olive Company. The requirement says explain the matters to be considered in perpetual inventory system on the completion and what should you communicate to TCWG regarding this. So I would say the first matter that I should be concerned about here is that when we talk about perpetual inventory count, there are certain deficiencies in the internal control. For example, we do not have the proper segregation of good received and good dispatched. Okay, so I'm writing in short form. You are not supposed to write that. Then, we can mention that we need to do substantive testing. Like if there were some differences, we are supposed to do substantive further additional evidences are supposed to be received, right? And there are some discrepancies, so we wanted to conduct full inventory count, but that was being rejected by the FD, the finance director, which also questions or it poses a question on his integrity. So maybe he's trying to hide something, so which is a question on his integrity. That led us to give, there is an inability in us to obtain sufficient and appropriate audit evidence because we were not able to conduct full inventory count. And our what should we report to TCWG here? We should report that there is a fraud which is going on in your client company, because that's why there were some discrepancies which were not being identified and resolved. Plus, the finance director is not letting us do the full inventory count. Then we can talk about the deficiencies in internal control and how they can, improve that. So we can talk about the test of control as well, and we can give them some recommendations that how can you improve these deficiencies. And then we will talk about the integrity issues of the finance director. This is what we will report to the TCWG in the first part. Second comes Sunny Company. Let's see what's happening here. There are some export restrictions from Farland. Let's see what's the ground reality. So Sunny Company is a listed company which manufactures food for airline companies. Okay, so it sources ingredients for their products exclusively from overseas supplier. Final materiality is 3,34,000, and on 10th August, following a drought and poor harvest, the government in Farland announced restrictions on the export of food products from the country for the next 6 months. So that means now you will not get your raw material. That might impact your going concern. Now, during the year, this has resulted in significant decline in the availabilities of supply, and the company has struggled to source alternative suppliers that are able to supply products at competitive prices in timely manner. So that is sure shot and uncertainty regarding going concern. Now, company's performance has also suffered as a result of three major airlines in homeland terminating contracts with Sun. So again, that is leading to loss of revenue and therefore going concern problem. Now, following improved harvest in the first half of 2015, the government last week announced that it may relax export restrictions over the next 12 months. But that is dependent on whether they continue to improve. Now, Sunny is currently in negotiations with the bankers in relation to request the extension of its borrowing facilities, which are expiring in August. So not just that your going concern is an issue from the aspect of supplies, but also that your loans are becoming to be repayable and you don't have money. Now, the company is also working with two of its former major airline customers to reinstate its formal supply contracts. So, Sunny company management is confident about the outcome of both sets of negotiation and will be very happy to confirm this in the formal representation. So, this is something which Sunny company says that we will have everything good in our financial journey because we are being optimistic here, and Sunny's management is confident about the outcome of the negotiation. So, what is the matter to be considered here and evidence that you should find? That first of all, this is a going concern problem, right? So, this is a going concern problem, which is material uncertainty. So, we will say it's a material uncertainty. And as per IS 1, I should have disclosed the material uncertainty in my financial statement. Okay, because and this is going to, you'll explain them in detail, that is why it's a going concern problem. You will explain that this will lead to loss of customers because the supply chain has been disrupted, and this will affect our revenue, which will affect our profits, which will lead to a going concern problem, plus our borrowing time is also expiring and we are in lack of money. So how will we repay our loans? So this is a deteriorating situation where we making you know we are loss making. So that is why we have a liquidity problem here. And we can't say that the evidence of written representation is not enough in this situation. Okay, so we need more evidence. So this evidence is not enough. We need more of the evidence here. And that should be like, if you have some customer contracts for future, you need to obtain those customer contracts. So what evidences you can write here which are needed extra? So we can just talk about maybe some budgets, some forecasts. So you can have a copy of budgets and forecasts in your working files to assess whether what is the future of this company. Then we can even have a you can say a copy of correspondence with regulators in Farnat to understand that when will the supply resume, right? Then we can even get a copy of correspondence with the bank, that what is the status of our loans, like what are the negotiations going on. So this is what you can obtain. Then you can get some customer contracts, copy of customer contracts to see that you have some in hand still, even though many of them have been terminated. So these are the kind of things that you can write as evidences for this situation. And then finally, what is your audit report? You will say that we need to see if our IS1 disclosure is given. We will give for 5 marks, we'll tell if IFRS disclosure is correctly given. Then we will simply install an MURGC para in the audit report, which will modify our report. And this MURGC paragraph is stated after basis for opinion. If our disclosure is, as per IS1, if the disclosure is inadequate, then in that case, we will be simply, this will lead to a qualified audit opinion. And this will not go into CAM, but this will go into basis for qualified opinion paragraph. Right. So this is what we will write for 5 marks. I've just given you an idea of what you have to write and not the exact word-to-word answer. That's it. So this is what we have in our pre-mock December for AAA. I hope everyone was clear on this. I tried to make it as short and crisp as possible because I wanted you to utilize this time. I've not made it a detailed one where I'm typing all the answers. It's more like a brainstorming session so that you understand that we have very less time left. If you have not covered this pre-mock yet, this was indeed a helpful resource for you. And that's it, guys. I hope it helped everyone. May God bless each one of you who's just viewing this lecture right now. And may you all pass with flying colors. That's what I hope and pray for. Thank you for watching it, and make sure you hit the subscribe button and like and share this video. Goodbye. Take care. All the very best.